Welcome to the Lone Star Capital Podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrouther, Director of Business Development.
On this show, we talk about real estate investing, business,
and so much more.
Welcome back to another episode of the Lone Star Capital Podcast. We've got the founder and CEO, Rob Beardsley, in the corporate studio. Alongside, I've got Sam Morris, our Houstonian, our boots on the ground, our Texas sheriff. Excited to always get the gang together here, the A-team, if you will, to discuss the latest and greatest in the market and Lone Star Capital and everything between. Real quick, if you are thinking about your September plans, we'll think again and think hard and think about September 14th and 15th as we've got the Lone Star Capital Summit, the 5th iteration, the best yet. The level of signups and the attendance already there is really remarkable. So I am confident to think and to say that this will be the best iteration yet, the best room yet, the most impactful. I think now more than ever, people are kind of figuring out, well, who the heck is actually doing deals? Where are they? Where do the capital allocators and providers, what's going on there? And if you're a capital provider, who the heck is actually a sponsor in business still? Well, you're going to learn at the Lone Star Capital Summit. So get your tickets, apply, reach out. You don't know, maybe you'll get a complimentary ticket. But that said, let's get right into a great agenda today to discuss some very important topics. First thing we're going to start with is insurance costs. So it's been no secret that expense ratios have been blown out of late and not a good sense. Expense ratios have been tough. You look at really since, the post-COVID situation since 21 and beyond 2021, you had supply issues. Then labor costs got expensive. Then material costs got more expensive. And then, labor was tough. So it was really difficult to kind of forecast the cost to run a property in relation to the revenue. And another big thing is, of course, insurance. Insurance was very challenging. We're in the Texas market. Even if you're in Austin, if you're in Dallas, we're obviously predominantly in Houston, insurance costs got hefty. And if you're in the Carolinas or Florida, it was likely even worse. But naturally, we're big Houston players, and your insurance numbers are very crucial. But it turns out we're finally starting to get some tailwinds in many aspects, not just insurance that we'll actually go through with revenue and collections, but insurance has been something that's actually been one of the brightest spots of the recent kind of auditing that we're doing within our portfolio, within our expenses and stuff. So Sam and Rob, why don't you take it away on the positive improvements we're seeing on the insurance side of stuff, which obviously inherently affect free cash flow and inherently create the cash on cash return and keep that alive and well.
Yeah. Rob, why don't you tell them about our renewal, and I can explain kind of what that means to the investor.
Yeah, I would love to. So the majority of our portfolio is in our master policy. And our master policy, people ask this question. They say, well, how long can you lock in your price? And unfortunately, insurance is a year-to-year thing. So our policy renews. It expires on May 31. So basically, we have a May 31 renewal every year. And this May 31, we were pleasantly surprised and very happy to see a roughly 32% reduction in property insurance. And so I just want to share a little bit more detail because every property has two components at minimum for their insurance. Well, really technically three. So you have property, which is the bulk of the cost. This is your property liability insurance. This is, wind. This is any sort of damage
Hail,
that happens. Yep.
hurricane.
Yep, absolutely. So your property coverage is the most important and it's also the most expensive. And so to see that come down 32%, very exciting. Your other insurances are general liability and umbrella. These are, general liability has been going up a lot because we continue to live in a very litigious society, and there's just been basically huge inflation in settlements. Someone slips and falls, $1 million, right? Not really, but that's kind of the idea. The people are just very litigious, and courts are paying out bigger and bigger money. And so these insurance companies that protect these companies and these properties against these sorts of liabilities are just seeing in response to these payouts that they need to increase their rates. So GL has gone up a lot. I don't think there's really much liability there, relief there. But the reason why there's relief on the property side is because the insurance market is very cyclical, just like many other markets. And so what you have is kind of the market goes and gets more expensive and more expensive because there were more losses, and then people got discouraged by those losses, and so insurance carriers actually exited the market. And obviously, when there's less competition, pricing can go up. But with the way that the markets calmed down and losses weren't too extreme over the last year, now there's more people who want to get back into the property casualty market, and they want to insure these multifamily properties in Houston and otherwise. And so with competition, that's bringing the prices down quite a lot. So it's a cyclical thing. And I think it's just a big reminder, like you mentioned about payroll and repairs and maintenance and all these other expenses, is real estate is a long-term business. And you might see kind of some losses, meaning like insurance not going your way or taxes rising and not going your way. But over the long term, we remain very confident that the dynamics, the tailwinds behind the asset class, where you've got rent growth, population growth, you have limited supply of affordable housing or workforce housing, over time, the asset class works itself out. And this is an example of back in 2022 when you saw year over year insurance just going up and up, and people were saying, well, why would I ever own multifamily investments? This makes no sense. Well, here you're seeing kind of things balance out again as insurance has come down, at least in our portfolio, 30%. And to put that in numbers, Sam, if we're looking at, let's say, your property insurance being around 1,000 per unit, and you get a 30% drop, so you could see a $300 drop per unit, and you've got a 300 unit property at a 5 cap, that's nearly $2 million of value creation. Now your property's worth $1.8 million more.
And Sue, that's the thing that our investors could really get excited about, right? Because for all of those investors who are in deals currently with us, the values for our properties just went up. And the reason they just went up is because that expense reduction, based on whatever prevailing cap rate you really want to use, is going to increase in value for the property, meaning the value of the property has gone up. And so, but it does a couple other things too, right? So there are really, all those expenses, we talk about the OPEX and things like that, but insurance and taxes, those are the two big ones that we don't control. And so when an uncontrollable expense reduces itself by that in any given year, for that matter, it's a big windfall for us operationally as investors, right? And for the market in general, right? Because it just helps. It's a high tide will raise all boats. And as more competition comes in, right, there's going to be more pressure to keep those rates even lower. And so it's a great, wonderful thing for us as owners to be able to see that, because it gives a little bit more credence to the long-term perspective that you're talking about, Rob. And so, it'll be something that will be of our benefit either on future exits or future refinances or things of that nature. And the current benefit would be when we redo our escrows and there's that much more cash flow coming in each and every month that we're able to pass along to our investors or build up reserves with, or things of that nature. And so it doesn't necessarily have that long-term impact. It also has an immediate impact for us as well that the investors will benefit from.
Yeah, it seems to me the long-term impact is naturally, on a multiple basis, if insurance stays low and, doesn't really increase like this, that inherently adds millions of dollars of value. But that's all nice, fine, and dandy. That's hard to really forecast. That's not really, helping my bottom line today, so to speak. But where the bottom line is helped today is, if costs are going down, X amount of percent, I mean, that's a lot more cash flow. It's going to investors to help pay down distributions, to help pay out the prep. So Rob, can you maybe share an example or two on, insurance costs going down and maybe the percent figure wise and what that translates from a cash flow perspective and, proportionally how much that might increase the monthly distribution or at least help us get to an increase there, if you will, to maybe even beat pro forma?
Yeah. So high level, we mentioned let's say $300 per unit decrease in insurance. So again, on a 300 unit property, that would correlate to about $100,000. And so I think we're going to have a few properties, a bunch of properties that are going to see, upwards of $100,000 decrease per year in insurance costs from the property master policy renewing. So that is if you take $100,000 on a deal of that size, you might be looking at something like 12, 13, maybe even $15 million of equity. So if you just take $13 million of equity, let me just do the math real quick. Uh, let's see here.
A little back of the napkin action here.
Yeah, so it comes out to being 0.77%. So almost being able to increase distributions by 1%. So that's a big deal. You fight
And
for
that's not
every
increasing rent.
point.
That's not increasing rent. That's just decreasing an expense, which is even cooler because if we can get some rent growth coupled with that, now we're maybe a point or two there.
Yeah, and that's only one line item too.
Yeah, and people don't. I mean, yeah, when you're in the front when you're on the front lines, you really start to appreciate every single point of cash flow distribution because those are all very hard fought. And so when you can have one come from one line item, that's very, very exciting.
Yeah, and I want to pull back a little bit here just for our process and how it works. Many people are asking us for deals. We wish we had a deal to send you right now. But with that said, when we do underwrite opportunities, we get a quote from our insurance provider. We get a low end and we get a high end. And just so everyone knows how we like to underwrite our opportunities, this is probably what was one thing that actually attracted Sam to work with us, was because we actually always show you the high end of the spectrum, the high end of the quote there, if you will, because anything we beat is gravy. But is it really fair to the investor if you're working with a group that always shows you the lowest end to kind of bait you in there? No, it doesn't really help anyone there. So we want to be very conservative. And that's one thing when we do actually say we're conservative in nature with underwriting. Well, that's one example there. And then lo and behold, we've got, a massive improvement on several properties that will only help our cash flow, our ability to, perform and do, good things. And this also ties back to a general theme of, economies of scale and also being experts in certain markets and getting the benefits from being an expert in the market, getting the benefit of having thousands of doors in a consolidated area. You get the benefit of wholesaling, pricing, and discounts.
One of the other things it does too, Craig, is I say this often that success begets success. So as you have a win, you can start to stack those wins. And one of the things that I'm hoping Rob will bring up too is we've started having some recent wins, and it's not just property specific, but we're seeing record level collections on certain properties. And so you do that coupled with lowering expenses, things really start to catch fire. And it gets exciting, not just for the investors that are in those deals, but for the teams that are running it for the corporate side. And so, Rob, you want to talk a little bit about some of the wins we're starting to see?
Great segue.
Yeah, definitely. I want to shout out some of our amazing properties and teams. So, first off, our Five Oaks property and team. That's a 228 unit property in Cypress Station in Houston. That's not an easy place to own and manage in. And they actually just totally blew it out of the water in May, and they had their record collections. We've owned the property since I want to say April or May of 2022. And so to see record collections here in May of 2025, super exciting. And it just seems like it's on the up and up. So that's really cool. And I think that's a combination. Honestly, I would say it's more of a management win than it is a market win, because I don't think that area of Houston is necessarily booming. I think there's other areas that are absolutely growing faster and better, where we are benefiting from that as well. But in this case, I think the team on site and our asset management team and our other corporate individuals are really just making things happen over there. And then also some of our more recent acquisitions, we bought handful of deals from Cortland last year, and two of them, Preserve at Copperleaf and Viscaya Apartments, also record collections in May. Preserve is absolutely insane. Preserve, we have 240 units. 238 of them are rentable because we have a model unit and we have a corporate unit, which we're actually moving because there's no vacancy. Preserve is such a hot product. We've got to free up that unit, and we're going to lease it up right away and create more income.
The gift that keeps on giving.
So listen to this. I think I have the numbers right. So 238 units are rentable at Preserve, right? And what we do every month is we have what we call a PUU bonus process. And so that stands for paid up units. We talked about this before on the show. it's a super cool way to align the interest between the on-site team, our corporate team, and our investors. Because the way that we've structured the paid up unit bonus is the on-site team, top to bottom, from the manager to the leasing agent to the maintenance supervisor to the porter. Everyone participates in this pooled bonus based on how many occupied units there are by the end of the month that have a $0 balance, meaning they don't owe any rent. So those are the types of tenants you want to have, the types of tenants that pay their rent and they don't owe anything by the end of the month. And of course, we don't like vacancies either. And so what we do is we set a minimum bar for how many paid up units the property should have. And then for every unit above that threshold, there's a bonus that is paid out to the property team. And this makes sense because obviously we want the property to hit a minimum level of performance, and then we're happy to share in the upside. In Preserve's case, because they are doing so well, and we've just stretched that minimum bar so high, for every additional unit above the minimum threshold that they have as a paid up unit, we actually give them 25% of the property's revenue for that unit, for every unit they have above the threshold. So we're literally splitting it 75-25 with them. But that bar is really high to hit. And in May, they hit 234 PUUs. That's 234 out of 238 possible, soon to be 239. So it blew us away, and that's why they had record collections in their year of ownership.
Looks like I'm gonna have
They
to
had
brush up my
Christmas in
resume.
May.
I might have to brush up my resume and start working there. They're making so much money. I gotta, go where the puck's going, right? And anticipate where people making the big cash, and that's within the portfolio management there, if you will, and the property management. But no, in all seriousness, this is amazing. What that also means too with the paid ups like this is, obviously we want our staff to make the most. We want everyone to have enough money go around where we have the best staff possible, because staff is what makes properties go around, makes investments go around. You're buying a $30 to $100 million business by way of real estate, and it's managed by people. So we want the best people there to manage. But what this also means is that our tenants are happy. We've created such an amazing community that people want to stay, that everyone's doing well. That is the sign of an incredibly thriving and healthy business, and it gets me fired up to be an investor. That is truly the gifts that keeps on giving. And we should have some more great news regarding that deal. We don't want to say anything yet. We can't say anything yet. But this is just more incredible news that people will be probably talking about a lot. And let's just say that deal is a home run, seemingly. Perhaps you could even call it a grand slam to this point. So we're just feeling
We're
blessed.
truly stacking wins there for sure.
Yeah. But, this all kind of goes generally to the theme of, let's just kind of just take it to the last several years, right? I got into the multifamily business in 2022, and it's not a secret that, let's just say, the world started to turn within the multifamily world right around the summer of 22 when rates started going crazy. Sam and Rob can speak to this more from a historical perspective, but the world started to change, momentum started to die, and debt started to really, really shift. But I think for the first time in 3 years, we're really starting to see some very positive information come out there, if you will. I mean, as I said, insurance is starting to get under control. Supply is starting to taper off, if you will. And we're starting to see actually in the REITs and in these bigger institutional owners that own, generally speaking, 2010 or newer property, but probably 2000s or newer. They're starting to get, whether it be the Camden, whether it be, the big multifamily owners, who they are starting to get record renewals within their properties. And we're starting to see that. And I think this is evidence of that. But we're starting to finally see some positive momentum, some positive direction. So if you're an investor and you feel a little bit beaten up and scorned, you're not alone there, if you will. But we're finally starting to see some positive direction that will, get you hopefully excited as the investor to continue down the path of this alternative investment, which is multifamily.
And it's so funny you say that because earlier this week, I was doing another podcast and they were pretty direct, and they just hit me with, why should an investor do multifamily at all right now? There's so many other options that are out there and things like that. And I said, you're right. There are a lot of options out there. I go, but when you invest, do you want to do it at a time where everybody's getting into it? Or do you want to do it at a time when, there's fear? And
When
there's
your Uber driver, when your Uber driver is telling you need to invest in multifamily, you're the sucker, right?
that's right.
When you're investing in 23 and 24, when no one was doing it, when it was not very much so in vogue, that's when you probably get your outsized return. And
Yeah.
I think we're looking at that right now as, okay, this is pretty sweet. These are the opportunities to do well. And capital flow would suggest that, the market is going to start ripping back. But any other kind of positive signs, Sam and Rob, that you want to maybe call out within our portfolio, or maybe general at a macro level, even more importantly, to, let everyone know that, hey, we're actually in a good space economically. And, there are some tailwinds, not some negativity there, if you will.
Yeah, the greatest thing that you actually said to me was the renewals. When you start seeing record level renewals, what that does for a property, I mean, it's literally it's so much better than new leases and things of that nature. I really can't really even describe it. I mean, the renewals is where you really make your money in this game, because if you're not having to turn a unit, you're not having to spend money to turn a unit. You're not having to spend money on a staff to go out there and market and try to find you new people to move to your spot. You are taking care of the resident, and you're actually operating in a manner that people desire to live in your facility. And so, when you're starting to see those tick up, and really across the board, it means that we're doing really well, and it's something that it's going to translate well to our investors' pocketbook.
Certainly. So these are the positive benefits that we're starting to receive, which is great, which kind of segues into the next thought, which is, why is it hard to buy deals in 2025 to this point? So let's address the elephant in the pipeline room, which is we haven't bought a deal yet to this point. I think that shows our discipline, but it also goes to show that the market is ever evolving and shifting. Now, have we had kind of some outlier years in relation to what the market was doing in 23 and 24, as I alluded to, when seemingly no one was buying? Yes, we have done an incredible job. I think we've acquired, roughly 140 million in 2023 and 190 million last year. So that's a grand total of what, about 330 or so million during, an economic kind of downturn there, if you will, within the space. Well, that's awesome. But we're looking around 25, and it's been a struggle to, appropriately, look at deals. Obviously, deal flow is kind of scarce right now. But Sam and Rob, do you guys want to maybe get into some of the reasons as to why it's been a skosh more challenging now? And then I also have another theme that we'll transition that into after your thoughts there.
Yeah, I mean, I think we're probably going to end up saying a lot of the same things. We read a lot of the same sources, Rob and I do. But a great reasoning would be, you're going to see a lot of these things, a lot of the headlines that are in the market too, right? You still have fairly good bid spread ask, bid to sale ask. So that spread's still there, meaning what the seller wants to get versus what it's truly worth today. Interest rates have been a bit of a challenge in the fact that there's really not a consistency in interest rates in the market, right? You can see it go up and down fairly drastically in the matter of one day. And when you're trying to, Rob had mentioned, earlier on another podcast that debt is kind of the center of what we do in a lot of things. And when there's some uncertainty associated with that, it really makes it difficult to underwrite. But really, from an availability standpoint, there's really just not as much product out there that's available for sale right now. I sent an article to Brad earlier this week about San Antonio that Cushman Wakefield had put out, and it said there was 6 transactions in all of San Antonio in Q1. And San Antonio is a pretty large market, for the country as far as population. But of those 6 transactions, the average vintage, so the average age that sold was 1972. That was the average age, and the newest one being 1982. So it's really specific of what's for sale versus what's distressed versus what would be an ideal asset to own in ideal locations. And for those assets that are, let's just say, great located assets that are good, that would be ideal for us to own, we are going to run up against some major competition.
Yeah.
I mean, look, good locations never go out of style. Great assets will never go out of style. And there will always be a lot of people that are desiring those.
Yeah.
So when they come up, you gotta take your shot.
Yeah. The 3 L's of real estate: location, 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 right? And then Phoenix, you mentioned San Antonio's had nothing trade. Do you recall the stats in Phoenix and how
It was similar. Q1, I think it was 6 assets, which, I mean,
How
Phoenix is the
how are
fifth
brokers in
market
business?
in the country.
Are they bartending on the weekends or during the weekdays? Like, sincerely, my thoughts actually go out to those who are in the brokerage business, particularly if this is your asset class. Like, there's no revenue to be made. These are title people now. So title agents and everyone on kind of that has ancillary stuff regarding sales and stuff. There's no money being created right now. Lenders are probably struggling. I mean, they might probably do a lot of recaps and refinances and loan modifications, stuff like that. So there's always something to be done there. But there's just very little transpiring as we speak. And we're in some of every MSA we're in, San Antonio is the smallest, but DFW is massive. Houston is the fourth biggest MSA in the country. Phoenix is the fifth biggest MSA in the country, which we're going to hopefully emerge into in the very, very near future. But there's just very little transaction volume going on right now. And I actually want to contrast this as well. As we talked about on the last episode of the podcast, the HB 21 bill, there was probably going to be a lot more transaction volume in Texas that likely would have been done, but a lot of people recaptured or not recaptured, but resized up their deals with the traveling HFC. So that would have likely created a lot more transaction volume in Texas specifically, throughout the various, different core markets there, if you will, that got put in a traveling tax exemption structure that may come to market a little bit later on, could actually flood the market with some more inventory. But I think that honestly, a lot of the tax exemption likely stymied some deal flow that would have came up naturally through maturity.
Could have, for sure. But you also are seeing, as tight as the lending market is getting, right? You're still seeing competition within the lending market. They still want to be able to do deals. Lenders don't want to take losses, so the extend and pretend is still there. I mean, and it's going to, all these things will, collectively make for a slower acquisitions market.
Most definitely. Robin, any 2 cents or thoughts here on this one?
No, I think it's pretty straightforward. We are highly incentivized to acquire property. Our business is to acquire assets. It is to partner with investors to acquire deals. It's what we do, and we haven't done it. So it tells you that there's something big going on in the market and that nothing can go on forever, right? So eventually something's going to give. Either owners are eventually going to capitulate and are going to be willing to sell at a lower price that meets kind of where buyers want to be, or interest rates are going to come down enough to where paying the price that owners want to get paid actually makes sense to do so. Or it's obviously going to be a combination of those things, as well as perhaps improving fundamentals where rents are growing to actually have income that justifies the price. All these things need to happen. But like Sam said, when things are out of whack, you've got a bid ask spread, meaning the price that a buyer wants to pay and the price that the seller wants to get. It's just, there's no overlap. So right now the gap is a little wide. And unfortunately, we've identified the best place in the market over the last couple of years has been in the category of better located, newer and nicer assets because they're more resilient, because they, because you can actually buy them, because the price the sellers want, it actually makes sense. But a lot of people are sitting on really the gold that we want to own. These workforce housing assets, these 1980s vintage assets, they're old enough to where there's meat on the bone. They're not too old to where they're a headache or a nightmare. And they're also located in an area that actually has growth and, you've got good demographics and things like that. Unfortunately, the price that people want for those assets is way above expectation because those are the assets that actually have been hit harder relative to the newer assets. So if you're talking about you bought at the peak and now your value is down 30-40%, you're probably, unless you're forced to, you're probably not a seller. And so that's why we're just not seeing hardly any transaction activity at all in our sweet spot bread and butter workforce housing space, which is really interesting to hear that statistic in San Antonio about the 6 trades, which is basically zero, that happened in San Antonio being in the 70s and 80s category, because that's very different than what's happening in Dallas and Houston.
Without a doubt. And it kind of segues perfectly to A couple of thoughts. James Zhang's podcast was talking about it, which the last episode was these groups now, they are officially, they've decided, they've kind of internally said, hey, the market is the market. We need to transact now. And interestingly enough, I was listening to the incredible new podcast, the Promote podcast, which I have been binging. I know I'm not alone there. The Promote podcast is awesome. So give them a listen. If you want to learn a little bit more, they're a wealth of knowledge and information there. But one kind of thought that I had here, which is where institutional dollars actually flooding into the market. Institutional dollars, this could be pension funds, this could be life insurance, whatever massive amounts of institutional capital are going to. Well, historically, a lot of it went to office. It went to various ranging asset classes, if you will. Now, where is it going? It's really going in three departments. It's going in data centers. It's going in residential, multifamily housing, build to rent, multifamily, master policy, single family homes, on large scale that people would rent out. And then finally into industrial real estate. But now that you've taken out, one of the food groups, which was office and, a couple of other things, that's only putting more equity and capital into the multifamily world, into the residential world, which is exactly what we're doing. So what does that in fact turn into in doing? Well, that's going to put downward pressure on cap rates. That's going to tighten cap rates on the entrance. So we've got our great friend Jeremy Roll, who's got Rollonomics, which is needing 150 basis points of positive leverage. Well, with how institutionalized the multifamily space has gone, there's enough reason to believe that we might actually never in fact see that spread ever again, so long as investing trends stay where they are right now. If, of course, caveated, you want to be in a market you'd actually want to own in and invest in, where there's good growth and things of that nature going on. So, trends and capital flows change frequently. And where institutional dollars are putting into is kind of what we're doing, which is just going to tighten the cap rate of these opportunities, I think, from a terminal perspective.
Yeah, a big measurement for that too, though, is risk, right? So you could probably you might be able to go find 150 bips difference, but you'd be buying an office building on an 11 cap or something like that, right? I mean, that's just kind of how that world works. And so if you're willing to take that kind of risk as an investor, you might be able to find that spread, but return of principal is still kind of front of mind to a lot of investors. And being in those three food groups you just mentioned, right? I mean, the likelihood of return of principal is probably greater than maybe others. And so even looking for those spreads that some investors may be looking for, it's still about risk reward associated with the dollars that you're putting in.
Even staying within multifamily, you talk about buying in a growth market like the primary markets in Texas where we're active. And even within those markets, you talk about buying actually in the high quality submarkets within that top market in the country. There's just absolutely no way, no reason for those deals to be priced at such a discount to be able to create such positive leverage. I don't want to go too geeky, but it just logically doesn't make sense. Why should you be able to buy a risk asset and get more income than a bond, but then you also get the appreciation. You get growing cash flow over time, and you get the appreciation of the asset as well, and you get the tax benefits. It just doesn't make any sense that you should be able to get such a juicy yield. Why should you be able to buy at a 6 cap if risk-free rates or your financing rates are 5%? It really just doesn't make sense. And Craig, like you said, we are in an institutionalized world where there's no secrets, there's no information gap. Everybody knows what everything's worth. Everybody has access to everything. So unfortunately, there's not these overlooked assets, these hidden opportunities, particularly when you're talking about institutional multifamily where the assets are 25, 50, $100 million deals. These are very large deals where you have 100% everybody is a sophisticated actor. Now, of course, people make mistakes. The market goes up and goes down. It goes against you. So that does still afford opportunities, but nobody's an idiot and nobody's just mispricing things.
Yeah, or not everyone's an idiot. There are some idiots, but I just like to think of, if you've ever seen the movie Margin Call, Jeremy Irons has a very iconic phrase. He's like, we're humans, we can't help ourselves. There's always going to be cycles, right? We all have an appetite, and there's the greedy nature in many people there, if you will, that allow those to get overextended. But all those reasons you mentioned, the cycle is just different now. And think about, in my shoes, in my position, in 23 and 24, we spent a lot of time speaking to institutional groups who wanted to put out one form of equity only, which was really pref. But they had massive buckets of, call it common equity, LP equity, that, they liked deals, but they didn't love the deals. They didn't think the upside was ripe enough. Well, now it's time for them to clear out their books, because they don't get paid to look at that capital. They get paid to put it out, and they need to put out money at some point and eventually just go in on certain deals. And they're starting to do it now. It's starting to be priced in. You're starting to see deals trade for almost silly numbers at points. We're starting to see some, big names in the space where we're competing on, call it 95 and newer deals, that are saying, you know what, we're the winner in this deal and we're buying it all cash, and then we'll refi it later, okay, with a 30-day close, or waiving environmental or silly stuff like that. They're making incredible and remarkable offers that, quite frankly, we would not feel comfortable doing, because we value you, the investor's money, too much. Good for them, because they maybe have a lower cost of capital to solve for there, if you will. But it's just an interesting, fluid, and ever evolving market. So that kind of just speaks and ties into, where capital flows goes, maybe why it's been a little bit harder to buy deals. It's twofold. It's not just that, there's not a lot of deal flow, but it's also the deals that are on there and are coming are getting bid because, people need to put out capital. So any final thoughts here before we wrap up the show?
No, I think it's a great time, to invest. I mean, to be able to win in the game, you got to be in the game.
Absolutely. And, I think we're seeing a lot of positive thoughts here. We think that, 5 years, which is the typical hold we're going to do here, by 2030, the market will have great growth. It seems like supply is dropping off a cliff, which is excellent. So if you want to hear the latest and greatest, keep listening to the show. If you want to learn and meet more people and expand your network, come to our Lone Star Capital Summit, September 14th and 15th, application or invite only. Go to our website to learn more about that, or reach out to me personally at craig@lscre.com if you want to learn more. For all those who have listened today, we appreciate you. And if you find this to be valuable, send it to a friend maybe. Take care, everyone.